Hey traders, Todd Gordon here. It is going to be the free video as well as the members video. We're going to start off with two charts here for the free video, and then we're going to roll into the members video from there. So I'm prepping for the Vegas Expo. I'm leaving tomorrow, and I'm actually doing one of the 4-hour premium presentations in intermarket analysis. So I've been doing some I've been working so hard on this presentation. And there's two charts I want to show you that I think are really interesting. Kind of figure out where we are longer term, where we're headed in the future, and yeah, it should be interesting. So we're taking a look at the volatility index, and then we're going to roll into the U.S. dollar. So to start, let's get into the VIX. And just kind of look at some relationships here of what the VIX has done here in the 21st century. The first kind of pattern that I'm looking at here starts on September. This is 9/11, September 2001. Okay, and the pattern starts out like this. Okay, we have a spike 1, and let's just call this. Let's call that number 1. Okay, so that's number 1. We then sell off and then go back and retest the old highs. Okay, so we have a high here and we have a high here. The period, the time elapsed between those two spikes was 46 weeks. Okay, fine. Then after those two spikes, 9/11, and then we get the actual market low around 2002, 2003. We then go into a period of VIX decline, which means SPX, S&P rallies. Okay, that lasted 203 weeks until we had our first significant spike. Okay, so from peak to peak, significant volatility peaks was 203 weeks. Now, what's interesting is this first volatility spike was an indication of things to come. We didn't know it at the time. So volatility spikes, then sells off back towards the range lows. Okay, markets then put in a top. That's when the credit crisis begins and the volatility goes up to like 85, maybe even got up to 90. Okay, so the pattern was spike, retest the highs, sell off, an initial spike to indicate that this downtrend is over in volatility, uptrend in stocks, retest the lows, and then we go. Fast forward to 2011, what do we have? I'm going to put another number 1. We have an initial spike after decline in volatility. Say, okay, maybe this stock market rally is coming a little, it's a little overbought here. So we have an initial spike, number 1. We have a second spike that retests the highs, number 2. We then go into a period, it's kind of like sliding into home base. We'll call that, here's number 2 here. We have a significant slide as stocks have been rallying for a couple years now. Then we have the initial spike up. Okay, so that's number 2 here. I'll do another number 2 here. Okay, so if history is to repeat itself after we have that initial spike, we should then go down and sell off, retest the lows, which is exactly what we're doing right now. Okay, then after a good 6, 8, 10 months of this, of retesting the lows, then volatility picked up. So another 6, 8, 10 months of low volatility on the retest of this low. I'm wondering if we're going to get another VIX spike. I don't think it's going to be another 90 VIX, which was just monstrous. But if this pattern is to play out, we could be in for a VIX rally here into 2015. So again, the pattern is, let me just go back over it real quick. It's a little confusing, but we have a spike, retest. Volatility goes down to the lows, puts in a double bottom, retests those lows there with that double bottom, spikes. So here we go again. Spike, retest, we get onto the lows. The initial spike to tell us that the period of easy stock market gains is over. Markets will settle down a little bit after that scare. We retest it, and then we go. All right? So keep an eye out on that. Wondering if that's going to play out. The other market that I thought was very interesting is the dollar. And this is... this chart's wild. Okay, so the dollar index, the U.S. dollar futures, 1987. I mean, obviously we had massive inflation there in the 80s, blah, 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 1988. And then we go up to 89, and then we begin to go into some of the wars, the first Gulf War. We sell off. Okay, so from 1989 to 1995, let's call that a swing. Okay, I think that is very safe to call a swing. I would say the swing in from the 80s was another swing. So I'm going to start it from here, which is June 11th, 1989, down to the lows in 1995. That was 305 weeks. Okay. As we got down to the lows, it took the ATR, average true range, a while to get down to its lows of around 90 cents on average in the dollar. So 90 cents is your ATR, average true range, week to week in the dollar. So fine, we find a low. Then we begin to rally. Okay, so this is clearly a swing from 1995 up to the high of the Nasdaq top 2001. That was a rally of 324 weeks. So we got 305 weeks, 324 weeks. Then we all of a sudden, then we start slashing rates, Greenspan slashing rates, no idea what's going on. And then we start going into the housing bubble there, and then this thing finally begins to pop. Okay, I'm going to call that the end of this swing. Okay, so that one lasted 349 weeks. Okay, so then all of a sudden, 2008, we started to get this dollar rally as the credit crisis really began. The housing bubble popped, and then it spreads to Europe and now the rest of the world. This has been the next swing, and it really hasn't been an upswing or downswing. It's just been a straight sideways trend, nothing. But what's interesting is if you measure it from March 2008 to where we are at the lows from May 2000 and this year, May of 2014, if that was the end of this swing, which is sideways, that was 320 weeks. We've since broken out through 86, which is the old high. We have some trendline resistance here. We could be up for a new move. All right. So what's interesting is, we had a low reading of about 87, 88 in the futures following the first swing. The next swing, we have a reading down around 76. I'm just looking over here on the ATR here, about 76, 77. When you get ATR less than 90 cents in the dollar's moving less than 90 cents a week. I mean, that's tight. And it usually is happening right around a trend change. Okay, so we got some good volatility in the credit crisis, but certainly nowhere near where the currency markets used to trade. But this has been a swing that, again, has just been super range bound. And now we just put in a low ATR reading that was like, I don't know, what is that, 70, or maybe below 70 cents, like 69 cents. I mean, just nothing going on. So, if that was the end of the consolidation and we've begun to move into a new trend, I'm going to call that swing over. So I put that right at the lows in May, and we've begun to break resistance in the dollar. So what that means, if you put it all together, what have we done? We've gone down, up, down, sideways, and now are we going up again? So do I put another green bar over here that would last, call it, let's give it 300 weeks to be conservative. 300 weeks is right there, which is a projection of February 2020, 6 years. So could we have a 6-year rally in the dollar? And then when you tie that back to volatility, I don't know. If we do get that skid into the lows over the next 6, 8, 10 months or whatever, and then the volatility index moves higher, I don't think that's going to be a higher stock market. There's a long-standing inverse relationship of the dollar and the stock market. So if this breakout for real, I mean, the volatility index might, have another couple quarters of retesting the lows before we spike up. And if this dollar is going to rally, it's probably going to be a safe haven rally, not a, this direct relationship we're seeing between stocks and the dollar, which I think is ridiculous. There's a long-standing inverse relationship between stocks and the dollar. So that should reassert itself. So, that's what we're on the lookout for longer term. And that's one of the topics that we'll be talking about here on Friday in the Vegas Expo. If you guys are interested, if any of you are going to be there, here's the information. Just go to tradinganalysis.com. And then on the homepage, there's a link right here, Vegas Traders Expo. And if you want, you can sign up. It's right there. Top 5 strategies for trading the 4 major asset classes as a professional. All right, so that'll be that. I'm going to roll into the members video now, and I will see you guys in Las Vegas. All right, take care.